Okay, guys. Hello, everyone. Guys, good morning. How are you all? Good morning, everyone. Hi, Ruchi. Hi, Rahul. Hi, Rahul. Hi. Hi, Irfan. Hi, Gopal. Hi, Lakshmi. Hello, everyone. Hi, Sunil. Hi, Chandan. Hello, Kiran. How are you all? How are you all? Audio, video, everything is clear, working fine. Yes or no? Hi, guys. Good evening. Audible, visible to everyone. Audio clear, video clear. All clear? Okay, so today we are going to discuss this module B, right? Module A, we have finished theory plus MCQs. Now let's start with the module B. Now let's start with module B, everyone. Okay. Hi Smriti, good morning. Hello Chandan, good morning. Hello everyone. Okay, so let's start discussing this module B. Okay, so the very first question of the class is there is a assertion, there is one statement, assertion, and then there is one reason given for that. First, according to Alfred Marshall, economics is concerned more with the human welfare than with mere collection of the wealth. Second reason, Marshall believed that wealth is an end in itself and achieve maximum wealth is the ultimate goal of economics. So you have to tell both A and R are true, and the reason is the correct explanation of A. Both A and R and true, but reason is not the correct explanation of A. A is true, but reason is false. Both assertion and reason are false. So you have to tell me the correct answer. Both are false. Okay, so Gopal is saying both are false. And everyone, please answer this question. Everyone, just please answer this question. You can all answer this question, guys. Just read out the question carefully and you can easily answer this question. Everyone, I want answer from each and every one of you. And whoever is watching this session, at least just please like and share the video. At least just please, guys, like and share the video. Everyone, everyone, please, guys, just like and share the video, guys. So Hema is saying D, Mohan is saying D. Now, means both A and R are false. In the last class, I have told you, in the evening class, I have told you, first of all, according to Alfred Marshall, economics is more concerned with the human welfare with rather than mere accumulation of wealth. That is true because when we are talking about Adam Smith defined economics as the study of wealth. Means from Adam Smith point of view, wealth is more important than human welfare. But according to Alfred Marshall point of view, Alfred Marshall defined economics as the study of human behavior. Remember, I have told you Alfred Marshall says that it is the study of the human, okay, rather than the study of the wealth. So this is the correct statement. There is nothing wrong in the first statement. Why you are all saying A is wrong? According to Alfred Marshall, yes, Alfred Marshall defined economics as the study of the human welfare, right? Rather than just mere accumulation of wealth. Second, Marshall believed that wealth is an end in itself and achieving maximum wealth is the ultimate goal of economics. Obviously, that is wrong. This is false. Marshall don't have this point of view that wealth is an end goal, right? So he said that wealth should only be utilized for promoting the human welfare. Wealth should only be utilized for the human welfare. Wealth is not the ultimate goal. Wealth is a mean to achieve the ultimate goal. Mean means it is a way, it is a path to achieve the ultimate goal, right? So wealth is a mean to achieve the ultimate goal, right? So he said that wealth is not the last goal. So obviously reason is wrong. So A is true and R is false. The correct answer is C, everyone. Okay, done, everyone. And every one of you, if you have subscribed to this channel, yes or no, you are notified by the YouTube in today's session, yes or no? Everyone, just please tell me. You are notified by the YouTube today or not? You get the notification, right, when the class is live, half an hour before and half an hour after. Yes. Rahul Solanki, where are you? Are you present in the class? Can you just answer these questions? Just please be active in the class. Okay, done. Okay, next question. See, now there are statements. Okay, Reserve Bank of India increases the repo rate to control inflation. A firm decided to cut the prices to compete with the new entrants in the market. The total employment rate of the country falls by 3% due to a slowdown. A consumer decide how to allocate their monthly budget between groceries and entertainment. The agriculture sector contribution to the national GDP decline over a decade. Now we have to answer which is the microeconomics and which is the macroeconomics. Everyone, read out the question carefully and then answer. Everyone, you guys, read out the question carefully and then answer. Which is microeconomics and which is macroeconomics? Okay, just read out carefully and answer the following question. Everyone, guys. Okay, Chandan is saying A is the correct answer. Krishna is saying B is the correct answer. And everyone else, micro and macroeconomics. Micro deals with individual, macro deals with nation as a whole. Remember, I have told you macro deals with the nation as a whole, micro deals with the individual. So tell me the answer here. Everyone, tell me the answer here. Jivita is saying A, Krishna is saying not B. Okay, C, okay. Sunil is saying C, Hema is saying A. Okay, okay. So see, now let's talk about this. Okay, first, Reserve Bank of India increases the repo rate to control inflation. This is macroeconomics dealing with the nation as a whole, obviously. Dealing with nation as a whole, macro. Next, a firm decided to cut the price to compete with the new entrants in the market. There is a firm. It is dealing with individual, so it is micro. It is dealing with individuals, so it is micro. The total employment rate of the country, the total employment rate of the country, nation as a whole. A consumer decided to allocate their monthly budget between groceries and entertainment. Micro. Agriculture sector's contribution to the national GDP decline over a decade. Macro. So macro. First, third, and fifth are macro. True. And second and fourth are micro. True. A is the correct answer. Everyone, yes, A is the correct answer. Clear? A is the correct answer, everyone. Done? Any doubt here? Where is Shirish? Where is Shirish? Done? Okay, next question. Now, next question. In a country X, individuals freely decide which goods to produce. Firm compete for profit and consumer choose how to spend their income. The government role is limited to maintaining law and order, enforcing contract, protecting property rights. Recently, there was a public debate whether the government should impose price control on essential goods due to rising inflation. Economists warn that such control might distort the free working of the market, leading to the shortage. Now, based on that above situation of country X, which of the following statement is correct? Country X operate closer to a laissez-faire market economy. Price control by the government are fully assigned with laissez-faire principle. Consumer and firms in country X are guided by the forces of supply and demand. Government intervention, even limited to the property protection, contradicts pure market economy principle. Now just judge it. This is country's X situation. According to this situation, judge these four statements and then tell me which of the following is correct and which of the following is incorrect situation. Okay, everyone, please answer this question. Everyone, please answer this question. Very easy question. You can just easily answer this question. Just please read out carefully. Very easy question. Everyone. So Rahul is saying A. Means you are starting to answer or not, everyone. Please answer this question. Just try to answer this question, everyone. And don't just run away because the questions are tough. I am making these tougher questions because of you all, right? I just want to ensure that everyone should have an idea that how much tougher question can asked in the examination, how can the easy question asked in the examination, okay? And I hope that you are all enjoying these tough questions, okay? Because that is not seen in your paid classes, right? At least you are enjoying the MCQ session, everyone. Okay, so Kiran is saying A is correct. Only first and third statement is correct. Jivita is saying C. First, third, and fourth is correct. Okay. Lakshmi is also saying C. Chandan is also saying C. Smriti Sharmila is also saying C. Okay. Now we have read this situation that company X are freely deciding to which goods to produce. Firms are competing for profit, chooses how to spend their income. The government role is limited to maintain law and order, enforcing contract and protecting property rights. Like so there was a minimal government intervention. When there was minimal government intervention means private sector is dominating the economy. It is aligned with the laissez-faire. So country X operate closer to a laissez-faire economy, yes, because there is a minimal intervention of government. Laissez-faire itself is called as non-interference of the government. So yes, country X are operating closer to a laissez-faire market. Okay, Ruchi? Okay, Gopal? Now, prices are controlled by the government. They are fully aligned with the laissez-faire principle. Now, see this. Price controlled by the government are fully aligned with the laissez-faire principle. Price control by the government means government has a lot of interference. Are this is a part of laissez-faire principle? No, because laissez-faire says that the non-interference of the government. Laissez-faire says that there should be non-interference of the government. So obviously B is wrong. Now, consumers and firm in country X are guided by the forces of supply and demand. That is true. Okay, this is according to this para. Government intervention, even limited to the property protection, contradicts pure market economy principle. When we are saying that it is a pure market economy, minimal government intervention are allowed. That I said now in the first para when I'm saying that laissez-faire is actually the non-interference or the minimal intervention of the government. So even if it is a capitalist economy, you cannot eliminate the role of the government. That is not true. Government is present. So if there is a right that is imposed by the government for protecting the property, that is acceptable in a pure market economy. Okay, so the limited role of government is accepted. It is not contradicting the idea of pure market economy. So it is also wrong. Okay. So it is also because it is saying that it contradicts the idea. It is not contradicting the idea. So it is false. So only first and third is the correct statement. So A is the right answer. Everyone, A is the right answer. Clear? If you have any doubt here, please ask everyone. Any doubt, guys? And please, just please like and share the video, guys. Everyone who is watching this session, just please like and share the video, guys. Each and everyone. Each and everyone. Next, which of the following best explained why sudden decrease in the price of oatmeal would lead to the fall in the demands of apples, even if apples remain unchanged? The question is asking which of the following statement best explain that why the sudden decrease in the price of oatmeal means there is a decrease in the price of oatmeal, okay, and it actually leads to the fall in demand of apples. So because of this, apples demand falls. Now just tell me, apples and oatmeals are complementary, so cheaper oatmeal reduces the demand for apple. Apples and oatmeals are substitutes, so cheaper oatmeal make consumers switches away from apple. Apple and oatmeals are independent product and a price change in one does not affect the others. Demand for apples falls because lower oatmeal price could cause a decrease in the consumer income. Now just tell me the answer. Everyone just tell me the answer. Everyone just tell me the answer. Everyone. See, apple and oatmeals are independent goods, so a cheaper price change in one doesn't affect the other. So you are saying that they don't have any connection. Everyone. So let's talk about first of all the uh, price and demand changes in a substitute and a complementary product. First, let's talk about this. Okay, substitute product means one is replaced by another, right? For example, we can say that, for example, the substitute, a normal example, I'm just saying of the substitute. Like, for example, I'm saying, okay, Maggie, and the another brand. Or, for example, like Chings. Okay. Now they are substitute. Now, if the price of the Maggie, for example, decreases, if the price of the Maggie decreases, then obviously you know that the demand of Maggie will increase. Okay, people will not purchase Chings, they just move towards Maggie. So the demand for Chings will also decrease, yes or no? Okay, so here in a substitute, if the price of one product decreases, the demand of another product also decreases. This is substitute. Like complementary, we are talking about bread and butter. These is complementary, right? Now, if the price of the bread but decreases, bread price decreases, it means that bread demand increases. Okay, and because bread and butter they goes together, people are consuming more bread, so they will consume more butter also. So here you will see the inverse relationship. Here you will see the inverse relationship. Now, which of the following best explain? Just listen what it is saying. Best explain. Now, the thing is, there is already the situation of the market given to you. Like there is a sudden decrease in the price of oatmeal, and it actually lead to the fall in the demand of apple. Price decrease due to which the demand also decrease. So according to this particular assertion, price, apple and oatmeal, they are behaving like a substitute product. We have to judge that why it happens. We have to explain that this is the market situation given to you all. This is the market situation given to you all. It is said that, okay, the oatmeal prices increases due to which the demand for apple decreases. Now tell me why. It happens because they are behaving like a substitute goods. Because in substitute good, if the price of one product decreases, people will shift towards that product. If the price of oatmeal decreases, people are shifting towards oatmeal, and so they are not consuming the apple. So, according to this para, oatmeal and apples are behaving like a substitute product. Cheaper oatmeal make consumers switches away from the apple. B is the correct explanation of what is asked in the question. We don't have to say that they are independent product. See, if they are independent product, then why this market condition was given? I have given the market condition to you all. You have to judge that why it happens. Okay. So it happens because it is a substitute product. Clear? Now, if you have any doubt, ask. Any doubt, ask. Everyone. Yes, it is a very tricky question. Yes. Everyone just please like and share the video, guys. Everyone please just at least like the video. Done? Can we move to the next question? Can we move to the next question, everyone? Yes. Next question now. Which of the following statement is or are correct about bank rate and marginal standing facility? Now we have to choose the statements which are correct about bank rate and marginal standing facility. In the last class, I have explained it. Okay. Bank rate helps in managing long-term liquidity while MSF deals with overnight liquidity shortage. Under MSF, bank can borrow fund without any collateral, similar to bank rate mechanism. Bank rate directly influences the base rate of the loan extended by the bank, whereas MSF immediate impact liquidity needs. MSF borrowing is done beyond the statutory liquidity requirement ratio and can be up to a certain percentage of net demand and time liabilities. So the correct answer for this question is, just read out the question carefully and then answer. Everyone, read out the question carefully and then answer. Everyone. Everyone. So A is correct. You are saying A is correct. Everyone, you are saying A is correct. Okay. Now see, the first thing is bank rate help in managing the long-term liquidity while MSF deals with the overnight liquidity shortage. Bank rate gives when RBI gives long-term loan to the commercial bank rate. MSF marginal standing facility means RBI is giving overnight loan to the bank, right? So A is correct. Now, under MSF, bank can borrow funds without any collateral, similar to the bank rate mechanism. True. Bank rate directly influence the base rate of the loan extended by the bank, whereas MSF impact the immediate liquidity. Okay. Now here you are seeing what? Second is MSF can borrow fund without any collateral. That is wrong. During MSF, we have to keep the collateral. Means MSF in the overnight funding, always the commercial bank has to keep some collateral, has to pledge some securities to Reserve Bank of India, right? But under bank rate, it can be without collateral. So bank rate, under the bank rate, RBI is giving loan to the commercial bank without any collateral. But MSF always needs a securities to be pledged. And under the securities pledging, SLR is allowed. Statutory liquidity ratio is allowed, right? Now, bank rate directly influence the base rate loan extended by the bank. That is correct. Whereas MSF impact the immediate liquidity need. Correct, because MSF is given for overnight. MSF borrowing is done beyond the SLR requirement up to a certain percentage of net demand time liabilities. Perfectly correct statement. See, when we are talking about the marginal standing facility, before the introduction of MSF, listen carefully. Before the introduction of MSF, banks are not allowed to touch their statutory liquidity requirement at any cost. SLR is what the bank is keeping with themselves, right? So before MSF, they cannot touch. But after the introduction of MSF, under MSF, RBI allows bank that, okay, you can dip into your SLR security, but up to a certain limit. Means you can just go beyond the SLR securities, but up to a certain limit. For example, if your statutory liquidity requirement is 18%, you are allowed to pledge a securities beyond 18%, but up to a certain limit, and that certain limit is NDTL. 2 to 3% extra you are going. Like I have 18% SLR with myself, but I want a bigger loan. Okay, I am pledging 20% of my complete deposit. It is over and above my SLR, 2% above my SLR, that is allowed. So now under MSF, you are allowed to give over and above your SLR requirement, but up to a certain limit, which is actually given in the flexibility of net demand and type liabilities. So yes, 4 is also correct. So 1 is correct, third is correct, fourth is correct. A is the correct answer and second is the wrong statement. And everything is given here. Bank rate and MSF difference. The complete question is based on this difference. I have given you this para also so that you can just revise it later, everyone. Okay. Second is very simple. See here. Collateral. The loan can be raised without pledging the securities. In the bank rate, you can raise the loan without pledging the securities. Means you don't have to, in some times, you don't have to give any securities. Okay. So RBI is giving long-term loan to commercial bank in a bank rate. So bank rate says that commercial bank without giving any collateral can raise loan from Reserve Bank of India. Right. But MSF says that when RBI is giving overnight loan to commercial bank has to pledge their securities. Okay, so the loan is actually given against a security. So MSF in second option, it is saying that MSF can borrow without any collateral. That is false. During MSF, they need collateral. During bank rate, they don't need collateral. Okay, done, clear. Next question. Now, which of the following pairs correctly matches the exception of law of demand with this corresponding definition? Are you all enjoying the questions? Everyone, are you all enjoying the questions? And if you are, just please at least like the video, whoever is watching this session. Okay. Now, which of the following correctly matches the exception of law of demand with its corresponding definition? Okay. Now, first, Given goods, given goods, goods which demand increases when the price rises due to the availability of superior substitute. Veblen goods, goods whose demand increases as the price rises because the consumer associate higher prices with better quality and exclusivity. Necessary goods, goods that experience a drop in demand when the price increases as the consumer can easily substitute them with other necessities. Income effect, a situation where an increase in the price leads to an increase in the demand for the inferior good because the people can no longer afford alternative. Correctly matches the exception of law of demand. Everyone please answer this question. Everyone please answer this question. Everyone. So when we are talking about these given good are said to be an exception of law of demand. True. But what the definition is given here? The goods which demand decreases due to the price rises. No, in given goods, I have explained that it is an exception of the law of demand where the price increase leads to the demand increase and the price decrease leads to the demand decrease. It is just like an inferior good. Why inferior good? Because there is a negative income and demand relationship. If income increase, demand decrease. If income decrease, demand increase. Given good is an exception of law of demand, but the definition is completely wrong. It is not superior, it is an inferior good. Plus, there is always a direct relationship. Price increase, demand will also increase. And that's why A cannot be the answer. Veblen goods, goods demand increase as the price rises. True, because higher price with better quality. Veblen good is a perfect example. Definition is also given. Though given good is also an exception of law of demand, everyone. But the definition is wrong. And why? Because the definition is wrong, and that's why I haven't take it A, right? Necessary is good. Necessary goods are not the exception of the law of demand. Necessary goods, you know that it experience a drop in demand when the price increase, okay, because people consumer have the substitute of necessary good, like wheat is the necessity, but if the price rises people will shift towards rice. Okay, why? Because necessary goods have substitute, so it is not an exception of law of demand. Okay, neither the income effect. So B is the correct answer, everyone. So B is the correct answer, everyone. Okay, good, everyone. Now, next question. The graph shows a shift. Now, please just listen carefully and then answer. The graph shows a shift in the demand curve from D1 to D. Okay, this is the graph. Now, see the graph is showing D1 to D2, shifting from D1 to D. Okay, this is the graph. D1 means demand curve is shifting to D2. What could be a possible reason behind this shift? What could be a possible reason behind this shift? First, a rise in the price of the product itself, a fall in consumer income, assuming that the goods is a normal good, a rise in the price of substitute good, imposition of higher taxes on the product. Now, please answer this question. Very good question. Just please notice and answer this question. Okay, everyone. Okay, everyone. Please answer this question. So Irfan is saying C, Hema is saying D, imposition of higher taxes on the product. Just listen carefully now. Jivita, just read out carefully. Don't rush. Read out carefully. Question is given as what? No, this is a very easy question. See, I just I just put my heart for all of you in the paid classes so that you just learn the concept, you just understand the concepts of these things. I know that these are the complicated thing for you all. And why I'm framing such questions, so that you should be tested in this particular things. Now, first of all, now just judge the all option. Just judge the all option. First, if there is a rise in the price of the product, rise in the price of the product, the demand will decrease. Okay? Okay. But when the price is rising, due to which the demand is decreasing, the demand curve will move upward. This is called as movements. You know that in movements, the price is affecting the demand. So A cannot be the answer. A cannot be the answer. In this, the demand curve will move upward in the same demand curve, right? Now, a fall in the consumer income, assuming that the good is a normal good. In a normal good, when income is increasing, demand is also increasing. And when the income is decreasing, demand is also decreasing. This is called as the normal good, right? Now, fall in the income of the consumer, a fall in the income leads to decrease in the demand. Now, decrease in the demand cannot shift the curve to rightward. It will shift the curve to leftward. It will shift the curve to leftward, obviously. Next, a rise in the price of substitute good. Very easy substitute. Maggie and Chings. I have told you, when there is a price rise in Maggie, the demand for this is going down. A rise in the price of a substitute product. So price rise here, demand decrease here. Okay. Now, when the demand is decreasing here, people are shifting towards chinks. So chinks demand increase because the price Maggie is expensive. Now people are not consuming Maggie, so people will shift towards chink. Now obviously the chinks demand is increase. Demand increase, yes, there is a rightward shift in the demand curve. Fourth, imposition of the taxes on the product leads to the decrease in the demand. Leftward shift. So the figure is saying there is a rightward shift. So C is the correct answer. Okay, right, everyone, yes or no? Good question. A very good question for all of you. Clear? Yes or no, guys? Can we move to the next question, everyone? Can we move to the next question, everyone? Yes or no? Good. Next question. Which of the following is definitely a major indication of state of the economy of the country? Rate of GDP growth, rate of inflation, number of banks in a country, stock of food grains in a country. Very easy. Major indication of state of the economy or a country. Which of the following is a major indication of the state of the economy? Very simple. Answer this question. Very simple. Answer this question. Which of the following is definitely a major indication? Obviously, the GDP growth. So, A is the correct answer. Obviously, the GDP growth. So, A is the correct answer. Right. Next question. If the price of the bread rises and the quantity demand decreases, which of the following is most likely the cause of this change? A decrease in the demand which shifted the demand curve to the left, a decrease in the supply which shifted the supply curve to the left, an increase in the demand which shifted the demand curve to the right, an increase in the supply which shifted the supply curve to the right. Everyone, please answer this question. Everyone, please. Everyone, please answer this question. I think this question is wrong. I think this question is wrong. There is definitely something missing. There is definitely something missing. So here actually the question is asking about like bread and butter. For example, just let me just complete it. Bread and butter. So if the price of the bread rises, obviously the demand will decrease. Okay. And if the demand decrease here, the people are consuming bread and butter together, so the demand for butter also decrease, right? So it is the case of the complementary product, right? Now, when the demand of butter is decreasing because of the substitute product, then yes, there is a decrease in the demand, which shifted the demand curve to the left. That is true. Is true when the question is asking about the bread. A decrease in the demand of bread, bread should be a compulsion here. Why? Because see, if the price of the bread increases, due to which the demand of the bread decreases, it will cause the demand curve to move. The demand curve will move upward in the same position. It will not going left, it will move upward in the same demand curve if the price is affecting, right? So this question needs more changes. Okay, I just miss out this word of butter, because a, yes, a will be the answer if I am judging the butter thing, if I am judging the butter, because the substitute, if the price of the substitute product rises, then yes, the demand of the product decrease, causing the shift that of the demand curve to the left, because the substitute product is another factor, right? And if the price is asking itself, means if the bread price rises and the demand of the bread is decreasing, now in this case the demand curve will move upward along the same demand curve, right? Okay, so this can be the answer. Yes. Okay, so this will be the case in case of substitute, when the question is asking about the substitute good. This need more changes. The question will need more changes here. Okay, now next question. Which of the following is statement about equilibrium, market equilibrium price is accurate? Okay, at market equilibrium the price tend to fluctuate continuously due to the constant changes in the demand and supply. The market clearing price refers to the price at which demand exceeds supply, causing persistent shortage. Now, which of the following statement is correct here? Everyone. Which of the following statement is correct here? Everyone, please answer this question. Everyone, please answer this question. You can all answer this question very easily. Just look out and answer this question. Very simple question. Very simple question. D. So all of you is saying D. All of you are saying D. All of you are saying D is the correct answer. Okay. Okay. Now, first, at market equilibrium, the price tend to fluctuate continuously due to the constant change in the demand and supply. No, market equilibrium means demand is satisfied with the supply, so there will be no constant fluctuating, it is fixed. Okay, when the demand meets supply, now it is a market equilibrium, there will be no more fluctuation, there will be no constant changes, right? So A is the wrong answer. Market clear price is also known as equilibrium price. Remember, equilibrium price. It refers to the price where demand exceeds supply. No, where demand is equal to supply. Obviously, no. So both the statements are false. Okay? Both the statements are false. Both the statement are false, everyone. Okay? Both the statements are false. Okay, guys, can we move to the next question? Yeah, at least everyone just please at least like the video, guys. And if you haven't subscribed this channel, everyone please subscribe to this channel, okay? Because whenever there will be a marathon, the whole marathon till 10th, you have daily marathon schedule in this particular class, right? So don't miss out any marathon session. Whenever there will be any marathon session, it will be live on this particular channel. So you have to subscribe it. The most important part, press the bell notification icon so that you will be notified whenever there will be a class here. Okay, everyone, done, clear? Okay, next question. Next question. Again, there is an assertion, there is a reason. Okay. Assertion: Reserve Bank of India adopted the Consumer Price Index as a key measure of inflation in April 2014, replacing the Wholesale Price Index. Reason: the Wholesale Price Index was found to be a better reflect price consumer price changes compared to CPI due to its comprehensive inclusion of goods and services. Please answer this question, guys. Please answer this question. Smriti is saying C and everyone else. Smriti is saying C and everyone else. Please answer this question, guys. Everyone. D. You are saying both assertion and reason are incorrect. Smriti is saying C. Assertion is correct, reason is incorrect. And everyone else. And everyone else. Okay. Okay. See. First, Reserve Bank of India adopted CPI as the key measure of inflation. Right. Replacing the wholesale price index. True. Wholesale price index was found to a better reflect of the consumer price changes. False. Consumer price changes are better reflected in CPI, where WPI judges the price change at the wholesale level, right? So R is incorrect. Assertion is correct. C is the correct answer. C is the correct answer. Yes. Yes. Next question. High fiscal deficit is a cause of concern for any economy. Okay. What does it denote? High fiscal deficit. What does a high fiscal deficit denote? It is a measure of the borrowing of an economy. It is the excess of total expenditure over total receipt, excluding borrowing. It reflects the decrease in the tax collection for this year, or it means the lack of liquidity and earning for the economy. Easy question. Easy question. It's a easy question, everyone. It's a easy question, everyone. Krishna, Kiran, Chandan, Hema, Smriti, you are all saying B. High fiscal deficit is a cause of concern for any economy. What does it denote? High fiscal deficit is a cause of concern for any economy. What does it denote? Fiscal deficit is the excess of total expenditure over total receipt, excluding the borrowings. B is the correct answer. This is the correct definition of high fiscal deficit, right? Okay, so B is the correct answer. Next question. What is a stagflation? Inflation with growth, deflation with growth, inflation after deflation, or inflation with depression. What is called as the stagflation? What is called as the stagflation? Stagflation is what? Everyone, please answer this question. What is a stagflation? Everyone, what is a stagflation? Everyone, please answer this question. What is a stagflation? Okay. Stagflation means when in economy, inflation, recession, and unemployment all together exist in an economy, then it is called as stagflation, right? Recession plus unemployment, it is depression. You know that. Depression plus inflation. So the correct answer is D. Right, everyone. Good. Everyone. Yes, everyone is correct here. Right, everyone is correct here. Done. Next question. Now read out this question. Now read out this question. Which of the following statement about the money multiplier is incorrect? Which of the following statement about money multiplier is incorrect? Money multiplier shows the ratio between broad money and reserve money. The key factor influencing the money multiplier are the currency to deposit ratio, required reserve, and excess reserve. The money multiplier is only affected by the central bank interest rate policy. Money multiplier, you have to answer. Money multiplier. Which of the following statement is incorrect? We have to choose the incorrect statement here. Incorrect. Incorrect statement. So, first of all, money multiplier is the ratio between broad money and reserve money. Correct statement. M3 by M0 is money multiplier. I have told you in the theory session. The key factor influencing the money multiplier are currency to deposit ratio. What is currency to deposit ratio? How much people want to hold the currency with themselves plus how much they are spending in the market. Required reserve means how much RBI is taking reserve from the commercial bank, and excess reserve means how much extra over and above the statutory limit, how much extra reserve the commercial bank has given to Reserve Bank of India. So these are the key factors which are influencing the money multiplier. True, right? Remember, what are the three main factors influencing the money multiplier? Remember this, right? Now, money multiplier is only affected by the central bank's interest rate policy. That is false. It is not only affected by the central bank interest rate policy. There are a lot of other influence also, like consumer preference to hold money in the form of cash, the excess reserve, the commercial bank reserve with Reserve Bank of India, because the factors I have written above. So obviously C is the incorrect statement. C is the incorrect statement. Okay, done. Yes or no? Done. Yes. Next question. Which of the following is not a revenue receipt? Everyone. Which of the following is not a revenue receipt? Everyone. Which of the following is not a revenue receipt? Everyone. Which of the following is not a revenue receipt? Everyone. Not a revenue receipt. Guys, just hold, please. Not a revenue receipt. Revenue receipts means neither increasing the financial liability nor decreasing the asset. Revenue receipt means neither increasing financial liabilities nor increasing the asset. Okay. First of all, not a revenue receipt. Wealth tax, it is a revenue receipt. Profit, it is a revenue receipt. Foreign grants, grant is given. Okay. Recovery of the loan. Now, foreign grants, which is actually received. Now, you can say it is received. Foreign grant received. Okay. Recovery of the loan means you have received the loan. It is decreasing your financial liability. It is decreasing. Yes, A is the correct answer, right? Because it is affecting the financial liabilities, right? So it is not a revenue receipt. Recovery of the loan. Okay. Next. According to which article, budget is replaced by annual financial statement? According to which article, budget is replaced by the word annual financial statement? Everyone. Annual financial statement. Yes, according to Article 112, very simple. Okay. Now, the last question of the class. Now, just please listen carefully and answer. Okay, this is the last question. We are ending the session, don't worry. This is the last question. Now, central bank implements an expansionary monetary policy, increasing the money supply in the economy. As a result, consumer and business have more money to spend, leading to the higher demand for goods and services. However, the producer are unable to increase the production at the same rate, leading to the higher price. Okay, due to a natural disaster, the supply of a key raw material used in the production of several essential goods is severely disrupted. Producer faces higher cost for these input. As a result, they increase the price of their product to cover the higher production cost. Which type of inflation is recurring in each scenario? Very simple question. Very simple question. Very good, very simple question. You can all answer this question, everyone. You can all answer this question. Very, very easy question. You can all answer this question, guys. First, the main thing due to which the price is increasing is the demand increase. So it is called as demand pull inflation. Second, raw material. Because of the raw material, market price is also increasing. Cost push inflation. So A is the correct answer. Okay. And cost push inflation is also called as supply shock inflation. Okay. Done. A is the correct answer. Done. So, did you all enjoy the session today, everyone? Yes or no? Did you all enjoy the session today, everyone? So this is it. This is the complete session for all of you. And if you have enjoyed the level of questions I have given you, so please at least like the video. Give your feedbacks in the comment section. That is very important. Please always just give this is actually a appreciation from your side, which we educators are receiving, which is a source of motivation for all of us. Why we are working so hard to receive the rewards. Like reward means your certificate, your appreciations, right? So please just give your feedbacks in the comment section, okay? And just thank you so much for watching this video. Like and share the video to the maximum you can. And if you haven't subscribed this channel yet, is a request, guys, that please subscribe this channel and press the bell notification icon. After I end this video, there will be a comment section. You will please comment your feedback there. Thank you, Chandan, Gopal, Jivita, Hema, Ruchi, Sharmila, everyone. Thank you so much. Thank you. Thank you, Sunil. Thank you so much, guys. Take care, everyone. Bye bye.